Well, we're probably not doing as badly as Japan is, but certainly in the red, 10,675. Harsha Upadhyaya, Chief Investment Officer at Equity at Kotak AMC, joins us right now on the show. Harsha, good having you. Thanks so much for joining in. But a hypothesis, let's presume you had some bit of cash in your portfolio right now. Would you stagger out the deployment, or would you wait for an opportunity, or would you deploy it lock, stock, barrel right now?
We do have consistent inflows into some of our funds, and we have been gradually deploying that into the market. I think clearly a month back there was a bit of a concern in terms of the sharp rise that the Indian markets had seen, and hence the valuations, at least on the large cap segment, were kind of more expensive. Now with the sharp correction that has happened over the last 4-5 weeks, we have seen valuations correcting to more comfortable levels. So to that extent, not only in the broader market, but also in some select large cap areas, there is money to be made for the long-term investor. But volatility is going to be high. We have so many global negatives as well as local negatives. So to that extent, market is going to remain choppy. But if you are not looking at volatility for the next 6 months, and if you are investing for 3 to 5 years, I think there is good amount of money to be made.
What would the focus be then? If you want to make fresh allocations, you may have a few names that are those high quality names in your portfolio. Do you keep adding on to those names only?
It depends on where the valuations are. In some of those names, the valuations have corrected quite significantly, and if there is no long-term negative for those businesses, and if it's only a short-term volatility, then obviously we are adding to same names. And also we are seeing many other stocks where we had some intentions of buying, but they were expensive at that point of time. Now they are also correcting quite nicely. So those are the incremental buys that we may do in our portfolios. But broadly, I think we'll stick to our positioning, which is more of non-consumption oriented sectors, and wherever the valuations are in our favor, we will look at that and go on building the portfolio.
Any new themes that you've identified as beneficiaries of the current turmoil that we're seeing? And I'm alluding to the specialty chemical space, which has become top draw in a falling market right now because of the benefits that they get. Do you feel that that should be a part of the portfolio?
Yes, we continue to hold on to our specialty chemicals, not only from a raw material cost benefit perspective, but also I think for over the medium to long term, there is going to be new opportunity that will come in terms of new businesses. I think starting with US-China trade war, and now with the coronavirus spread, clearly the global majors are looking at alternate supplies to China. And India happens to be one of those regions where it can actually compete with China now, especially given that new manufacturing will have only 15% corporate tax. So overall, we'll continue to hold on to specialty chemicals. But if you look at the global scenario today, there are two major benefits that have happened to India as an economy, as well as Indian corporate world, which people may be ignoring at this point of time, given the panic in the market. The first and foremost has been the fall in commodity prices, including crude. I think crude has almost fallen by 45 to 50% from recent highs. So that's a big boost for most of the manufacturing companies in India, not just the crude beneficiaries which are directly related to crude prices, but I think across the board manufacturing companies will have their fuel cost and manufacturing costs going down. So that's a benefit. The number two benefit is in terms of the lower interest rates globally and higher liquidity. I think given the sluggishness that the government, the globe is seeing in terms of the economic growth, we are certain that the easy monetary policies across the world will continue. That also gives more room for our own Reserve Bank of India to look at possible rate cuts going forward. If you look at the 10-year yields today, I think it's at the lowest level since 2009. I think rates and commodity prices which are going down would be two big positives for Indian corporates as we go ahead.
And the fact that even crude oil prices coming off is going to be a net positive for us. Do you feel that the government has that much more ability to give an additional stimulus if and when required?
Very true. I think every $10 fall in crude improves our current account deficit by almost 50 basis points to the GDP, and we have already seen almost $30 of fall in the last couple of trading sessions. Not that the trend will continue or will remain at these levels, but wherever it settles, I think it's going to be much lower than the assumed price range for the next year, which is at about $65 to a barrel. So that will be a permanent positive for India, and that can be used to clean up our finances, which are anyways looking for some sort of a tailwind. And this is going to help government finances, as well as in case government needs to give any stimulus, I think they will have some ammunition left. At the same time, we are also not seeing any change in retail petroleum prices. There will always be a lag between the import prices and the local prices. So to that extent, I think government can also benefit if there is a significant fall in petroleum prices. Before it passes on to the consumers, they will be able to keep some money aside, which can be used to set right the finances overall.
Harsha, you reckon the developments over the weekend have contained any collateral damage that would have happened as a result of Yes Bank, or do you think that is still a bit of an unknown?
I think the volatility will still persist, but I think there is no issue with the stability of the financial system as such. Yes, there is going to be a moratorium for some more time, so to that extent the depositors may feel the pinch. Similarly, those who have banking relationships or those who are trying to raise money through additional tier 1 bonds could also face some issues. But for the overall financial system, I think this was something that had to be done anyways. We all knew that along with IL&FS, DHFL, etc., Yes Bank was also one of the overhangs that was there for Indian financial system as a whole, and that seems to be kind of getting stabilized now. So I think over a period of time, this should help calmness in the market.
Harsha, the other bit is while we all talk about the benefits of the falling crude prices to the economy and to companies, what about the upstream space? Now, the valuations out there compared to historical dividend yields, or however people want to calculate, are obviously a lot more attractive. But this is a bit of a new economic order as far as crude goes, and if indeed it stays lower, it could have a bit of a lasting damage on earnings. Would you believe that it's better not to bottom fish into the upstream space right now?
Yeah, as Neeraj, as you said, in some cases, price to earnings multiple is lower than actually historical dividend yield. So if you believe that dividend yield is going to continue, there is a lot of money to be made. But clearly, I think the profitability is going to get impacted, at least in the short term. So to that extent, very difficult to say that at what level some of these companies would stabilize. But outside the oil exploration space, there are a lot of other businesses, as we discussed earlier, which will definitely get impacted positively. And I think if the valuation is correct in those space, it would be better to invest in those pockets rather than oil exploration at this point of time.
All right. Not just oil exploration, Harsha. What's your take on investing public sector enterprises in general? Aside from the fact that they've been good dividend yield plays, they've not really returned much to the shareholder.
Yes, clearly our investment focus has been on public sector units which are fundamentally strong and which have been doing business in a reasonable manner. So we are not just looking at the valuation and jumping into some of these businesses, because there are various kinds of overhangs that are there, including further disinvestment or ESG concerns, etc. So I don't think one can take an across-the-board call on all public sector units, although valuations seem to be quite attractive. But it is beneficial to look at some of those public sector units where valuations anyways have been fair, but also the business seemed to be quite reasonable and quite steady. I think those are the names where you will be finally making money rather than across the board in our view.
Tata Motors is now at 108 rupees, so you're very close to slipping into the double-digit mark. Not that that's any significance, but I'm just saying, purely from a price watcher's perspective, that's a substantial downtake that has come in to that name. So do watch out for that. Some of the FMCG names like HUL, Nestle are holding out slightly better. The defensive bet coming in, so good going for those companies as well. But at the broader end of the spectrum, the damage that's happened to companies that had exposure to even bonds of Yes Bank, and that's really palpable. You can actually see and feel the kind of pain that is there into some of those. Harsha, one final question really. A lot of people are talking about how our divided view on the export-oriented themes. View one is that you would naturally benefit currencies going down and exports would go up in the wake of China not being able to do that. But view two is also this: with the tightening credit conditions in the US, companies might be reluctant to spend, and therefore the case in IT is not as simple as it's being made out to be. What's your sense here?
Neeraj, I think clearly export segment is going to be quite patchy, and we'll have to be selective in choosing our companies for investments. I don't think just because China hasn't been able to export some of its exports, that benefit is going to straight away come to India. I think there are a lot of issues that Indian manufacturers will have to resolve before they can actually compete with China. Yes, in select segments, we will be able to compete, we'll be able to offer the same quality, we'll be able to offer similar kind of supply chain dynamics, etc. But in many cases, the vendors may not have been approved at this point of time by global majors. So just because there is a disruption, it doesn't mean that India will suddenly be able to start supplying to some of those global majors. So I think it's going to be a process rather than an overnight shift. But I think some industry segments, as I mentioned earlier, like specialty chemicals, were forecasting this kind of a disruption quite early. And those have prepared themselves to actually take a space in the global exports market. I think in those cases, it will be much faster as compared to, let's say, auto ancillaries, where the vendors will have to be approved by original equipment manufacturers, and that process itself is very, very long. And also the capital expenditure that you do will have more gestation period as compared to, let's say, some of the other industries. So I think you will have to be choosing your businesses rightly in terms of where the benefits are going to be in the near term or in the medium term. And then if the valuations are on your side, I think that's where you'll be able to make money over a period of time.
Okay, got that. Harsha, it was great chatting with you. Thank you so much for joining us this morning.